Stop everything you're doing right now. I mean everything. Because what I'm about to show you isn't a prediction. It's not a theory. It's an internal directive, a ghost of a document that was never meant to see the light of day. This memo originated from the commodity trading desk at Morgan Stanley. It was sent to their most elite institutional clients, hedge funds, sovereign wealth funds, the top 1% of the 1%. And it contains 3 words that should make your blood run cold. Exit all positions. Think about that phrasing for a moment. In the world of high finance, words are chosen with the precision of a diamond cutter's blade. They didn't say reduce exposure. They didn't say rebalance your portfolio. They said exit. In the language of Wall Street, exit is not a suggestion. It is an evacuation order. It is the command given when the ship is no longer salvageable. Morgan Stanley, a titan with over $2 trillion in client assets, is telling its people to abandon the silver market entirely. And they have set a hard deadline, the end of this month. This is not a recommendation. It is institutional panic. It is the smartest people in the room realizing they are sitting on a ticking time bomb. And they have calculated they have days, not weeks, to get clear of the blast radius. Now, let's talk about why. The memo itself is surprisingly brief, but every word is a tactical strike. Paragraph 1 is the technical trigger. It states that due to extraordinary volatility and, this is the key phrase, structural changes in the silver derivatives market, Morgan Stanley is advising clients to close every single long and short position. Structural changes. That is Wall Street's code for the game is broken. And to understand what that means, you need to understand the silver market's paper bridge. For decades, the market has functioned as a bridge between paper claims and physical metal. For every ounce of real silver, there are hundreds of ounces of paper silver trading in futures and options. The system only works because 95% of traders never actually want the metal. They're just betting on the price. They roll their contracts over or settle in cash. Only a tiny fraction ever show up at the vault and say, "Give me my silver." The paper bridge holds as long as the traffic, the delivery requests, remains a trickle. But when Morgan Stanley says structural changes, they are saying the foundational supports of that bridge have developed massive, invisible cracks. The engineers are no longer confident it can hold the weight of a single car. You don't try to drive slowly. You don't try to lighten the load. You close the bridge. The structural integrity of the entire paper pricing mechanism is failing, and they are telling everyone to get off before it collapses into the river below. Morgan Stanley's models aren't just seeing cracks. They're witnessing a vault being hollowed out in real time. The first crisis is inventory depletion, and the numbers are staggering. COMEX registered silver inventory has plummeted. It has fallen below 32 million ounces. To the average person, 32 million might sound like a lot, but in global finance, it is a drop in the bucket. It is the lowest level we have seen in over a decade. But the absolute number isn't what has Morgan Stanley terrified. It's the velocity of the decline. Just 6 weeks ago, that registered inventory sat at 41 million ounces. That is a loss of 9 million ounces in a month and a half. That averages out to 1.5 million ounces of physical silver vanishing from the vaults every single week. If you do the simple math, at that rate, the registered inventory hits 0 in about 21 weeks. But markets don't move in straight lines, they accelerate. In the last 14 days alone, the vault lost 4 million ounces. If that new accelerated rate continues, we are looking at an empty vault in 8 weeks or less. Now, the skeptics will point to the 230 million ounces sitting in the eligible category. They will tell you that metal can be moved into the registered category whenever it's needed. But here's the secret that the big banks know, that eligible metal does not belong to the exchange. It belongs to private institutions, wealthy families, and hedge funds who are using the vaults for secure storage. They have absolutely no obligation to sell that metal. With physical silver premiums skyrocketing in places like Shanghai and London, why would they sell to the COMEX for the paper price? They won't. The eligible metal is frozen. It is not a backup supply. It is a private hoard. This means the registered inventory is the only real buffer the system has, and it is evaporating before our eyes. Morgan Stanley has seen this movie before, and they know how it ends. They are calculating the mathematical countdown to empty vaults, and their conclusion is simple. The system is about to face a force majeure event. They are telling their clients to exit because they no longer believe the exchange can meet its delivery obligations. The first pillar of the paper bridge is crumbling. But a collapsing vault is only half the equation. The second crisis is the explosion in delivery requests. To understand why this is so catastrophic, you have to understand the big lie of the silver market. Historically, as we said, it's a paper market. Only about 1 to 2% of contract holders ever stand for delivery. The system is built on that assumption. But that ratio is shifting violently, and Morgan Stanley's data shows it's accelerating. In the last delivery cycle, 9% of the open interest stood for delivery. That is nearly double the historical norm. And the preliminary data for the upcoming month is even more extreme. Some estimates from their trading desks suggest that 12 to 15% of all contract holders are going to demand physical metal. They don't want cash, they want the real thing. Let's look at the arithmetic of disaster. There are currently roughly 160,000 open contracts for silver. Each contract represents 5,000 ounces. That means there are claims on 800 million ounces of silver floating around in the paper market. If 15% of those people demand their metal, the exchange needs to deliver 120 million ounces of physical silver. But remember, there are only 32 million ounces in the registered vault. It is mathematically impossible. When that happens, the exchange defaults. They declare force majeure. They tell the buyers, sorry, we don't have the metal. Here's some cash instead, based on the paper price. But the moment that happens, the illusion is shattered. The entire premise of the paper market, that it represents a claim on real metal, is proven false. The paper price becomes meaningless because everyone realizes that the paper doesn't actually represent the metal. This is the structural change Morgan Stanley is warning about. The system is facing a delivery demand that it was never designed to handle, and the only possible outcome is a formal admission of failure. This isn't a slow leak, it's a rupture in the main pipeline. And this demand isn't coming from nowhere. It's being driven by a vacuum in the East. For decades, the Western banking system used the paper silver market to suppress the price, creating an artificial abundance. But the rest of the world is no longer playing along. In China and India, there's an insatiable hunger for physical silver, both for investment and, critically, for industrial use in solar panels and electronics. Smart traders are buying silver at the cheap paper price in New York and London and shipping it east to sell at the real physical price, which carries a massive premium. This arbitrage is vacuuming physical metal out of the Western vaults, which in turn motivates more people in the West to stand for delivery before their chance disappears. It's a self-reinforcing loop that is breaking the paper price mechanism. Morgan Stanley sees this Eastern demand not as a separate market, but as the force that is actively dismantling their own. The second pillar of the paper bridge isn't just cracking, it's being actively pulled away by a gravitational force they can't control. But the physical shortage and delivery demand are only the visible tremors. The third crisis is the one almost no one in the media is talking about, and it's the one that truly terrifies the big banks, counterparty risk. Beyond the public exchanges, there exists a massive shadow market for silver. We're talking about over-the-counter swaps and derivatives that never see the light of day. Conservative estimates suggest there is between 5 billion and 10 billion ounces of notional silver exposure in these private contracts between banks and large institutions. A huge portion of this is held by entities that are net short. They have sold silver they do not actually own, betting that the price will stay low or fall. As the physical market dislocates, these short players are starting to bleed. The problem isn't just the rising paper price, it's the exploding physical premium. A short seller who needs to deliver metal can't just hand over cash based on the fake paper price. They have to go into the physical market and buy the real thing, paying a premium that might be 50 or 100% above the spot price. That's a catastrophic loss. Morgan Stanley can see this pressure building because they are part of the interbank lending network. They can see which other banks are suddenly scrambling for collateral. They see who is quietly drawing down their emergency credit lines. They are witnessing the early warning signs of a liquidity squeeze among several major players in the silver space. This is where the risk becomes existential. In a globalized financial system, every major bank is connected to every other bank through a web of derivatives and loans. It's a row of dominoes. If just one of these over-leveraged players fails to meet a margin call or cannot fulfill a physical delivery obligation, the contagion will spread instantly. The failure of one bank creates a hole in the balance sheet of the next, and so on. Morgan Stanley has looked at the board and realized that the first domino is wobbling. They know that when the system breaks, the authorities will step in, but not to save everyone. They will step in to protect the system itself, and that usually means sacrificing the most exposed players to save the core. Morgan Stanley's memo is their declaration that they refuse to be one of those sacrifices. By exiting all positions, both long and short, they are insulating their entire balance sheet from the coming contagion. They're getting to cash now so that when the counterparty collapse begins, they are not just a spectator. They are one of the few entities with the liquidity to potentially scoop up assets from the wreckage. This isn't just about avoiding losses in silver, it's about surviving the systemic shock that a silver market failure would trigger. These three crises aren't happening in isolation. They are feeding into each other, creating what we call a doom loop. Morgan Stanley's proprietary models show that once this loop reaches a certain velocity, it becomes exponential and irreversible. It starts with the falling inventory we just discussed. As the public sees the COMEX vault levels dropping below critical thresholds, a psychological shift occurs. People who are content to hold paper contracts start thinking, if the silver is actually running out, I better get mine now before it's gone. This nervousness translates directly into action. More people decide to stand for delivery on their futures contracts. But this increased demand for physical metal drains the vaults even faster, accelerating the very depletion that caused the panic in the first place. It's a classic feedback loop, where the symptom of the problem intensifies the problem itself. As the vaults drain, the second stage of the loop engages. The banks and large speculators who are net short silver, those who have bet against the price, realize they are in a trap. To cover their positions, they need to buy silver, but they can't just buy a paper contract and roll it over. If their counterparty demands physical delivery, they need to deliver the actual metal, so they are forced to frantically buy physical silver on the open market. This frantic buying from the very entities that were once suppressing the price creates intense upward pressure. As the price starts to spike, it acts like a signal flare to the entire financial world. Investors who had ignored silver suddenly see it moving and want in, not as a speculative trade, but as a store of value. This brings a new wave of buyers into the market, further draining the remaining inventory. Simultaneously, the third element of the loop activates the great divergence. The physical premium, the extra cost you pay over the paper spot price to actually get a coin or a bar in your hand, begins to explode. Why? Because the physical market is sensing the scarcity that the paper market is trying to deny. When the premium gets high enough, say $10 or $20 over a $30 spot price, it broadcasts a powerful message to the world. The paper price is a lie. This realization causes even more participants to lose faith in the paper system altogether, leading them to abandon futures contracts and ETF shares in favor of tangible metal they can hold. This mass exodus from paper further cripples the liquidity of the derivatives market, making it harder for anyone, especially the shorts, to execute an orderly exit. The cycle continues to spin faster and faster. Falling inventory begets delivery demand, which begets short covering, which begets price spikes, which begets more panic buying, which begets higher premiums, which begets a total loss of confidence in paper. Morgan Stanley's data indicates we have already entered this acceleration phase. The window for a controlled exit is closing rapidly, and their month-end deadline is a mathematical projection of when the cumulative stress will exceed the system's breaking point. They aren't predicting a collapse. They are observing one in progress and calculating the moment of terminal failure. To understand why Morgan Stanley is acting with such brutal urgency, you have to look at their institutional memory. This isn't the first time a leveraged market is broken, and the banks that survive are the ones who learn from history. They have a playbook for this, and it's written in the ashes of past financial disasters. The first and most famous precedent is the Hunt brothers saga in 1980. The Hunts had accumulated a massive physical hoard of silver, and the price had rocketed from single digits to nearly $50 an ounce. The big banks, caught in massive short positions, were facing ruin. But what happened? The exchange changed the rules overnight. They implemented liquidation-only trading. You could sell your silver, but you were not allowed to buy. This artificial intervention crashed the price and destroyed the Hunt brothers, but it saved the banking system. The lesson for Morgan Stanley is clear. When a market breaks, the authorities will not hesitate to change the rules to protect the entrenched powers. And when the rules change, someone gets sacrificed. Morgan Stanley's goal is to ensure they are not the sacrifice this time. They are getting out before the rulebook is thrown out the window. The second, more traumatic lesson comes from 2008. The banks that survived the subprime mortgage crisis weren't the ones who were right about the housing bubble. They were the ones who moved first. The institutions that recognized the systemic risk and sold their toxic mortgage-backed securities while there was still a functioning market lived to fight another day. The ones that hesitated, believing the problem was contained or that the government would bail everyone out, ceased to exist. Lehman Brothers is the most stark example. Morgan Stanley itself teetered on the brink of collapse during that crisis. They learned the ultimate Wall Street lesson firsthand. When you identify a systemic risk, you don't wait to be proven right. You just get out. The cost of being early is minor compared to the cost of being late when the entire system seizes up. And we don't have to look back decades for proof. Just look at the nickel market in 2022. A massive short squeeze, driven by geopolitical tensions, sent nickel prices soaring from around $20,000 to over $100,000 per ton in a matter of hours. The market broke. The response? The London Metal Exchange halted trading for a week and took the unprecedented step of canceling billions of dollars worth of already executed trades. The people who were on the winning side of the trade, who were about to make fortunes, had their profits erased to save the short-selling insiders who were about to be wiped out. This event shattered the illusion of a free market for everyone watching. It proved that when the losses become too great for the powerful players, the concept of a contract and a settled trade becomes meaningless. Morgan Stanley sees the same warning signs flashing red in the silver market today. They see the same unsustainable short positions, the same physical supply constraints, and the same potential for a price explosion that would trigger a systemic event. They are refusing to be on the wrong side of that trade cancellation. They are getting out now, not because they are certain of the timing, but because they are certain of the outcome. The historical precedent is clear. In a breaking market, the first ones out survive. The ones who wait for the official announcement are left holding worthless paper. So if Morgan Stanley knows the system is about to break, a logical question is, why tell anyone? Why not just quietly dump their own positions and let everyone else take the fall? The answer is a cold calculation of legal protection and strategic self-interest. First, there's the matter of fiduciary duty. Morgan Stanley manages money for its elite clients. If the bank's proprietary trading desk exits the silver market, causing a price move that crushes their clients' positions, and they said nothing, they would face an avalanche of lawsuits. By sending this memo, they are creating an undeniable paper trail. They can point to it and say, "We warned you. We fulfilled our legal obligation. The losses you suffer are now on you." It's a defensive move to shield themselves from the legal fallout of the coming collapse. But the second reason is even more critical. They need an orderly retreat. Think about the scale of Morgan Stanley's exposure and that of their clients. If every institution that received this memo tried to liquidate hundreds of millions of dollars in silver derivatives in a single afternoon, the market would flash crash to zero. There would be no liquidity. The exits would be jammed shut, and nobody would get out. By setting a public, internal deadline of month end, they are attempting to manage the exodus. They are spreading out the selling pressure over a period of weeks, creating a controlled flow of sell orders that the market can, in theory, absorb. This isn't an act of kindness, it's a calculated strategy to create the liquidity they themselves need to escape. They are using their clients' selling to provide the bids for their own positions. It's a strategic withdrawal, not a chaotic rout, and the warning is a necessary tool to make that withdrawal possible. This action gives you a rare, unfiltered look behind the curtain. While retail investors watch a seemingly stable $30 spot price on their screens, the giants are already halfway out the door, coordinating their retreat to avoid setting off the alarm bells until they are safely in cash. As this institutional evacuation plays out over the coming weeks, you are going to witness a phenomenon that will redefine the precious metals market: the Great Divergence. For decades, the price of a paper silver futures contract and the price of a physical ounce of silver have moved in near lockstep. That relationship is about to break permanently. Here's what will happen. As Morgan Stanley and other institutions follow the exit all positions directive, they have to close both their long and short trades. This creates a bizarre bipolar volatility. When they cover their massive short positions, they have to buy, which will cause violent, unexpected price spikes. But when they liquidate their long positions, they have to sell, which will trigger equally violent crashes. These whipsaw movements will be exacerbated by the stop-loss orders of thousands of retail traders, creating a market that looks like it's having a seizure. But the most important effect will be on market structure itself. Remember the memo's key directive: prioritize orderly liquidation over price optimization. When the biggest players in the market stop caring about getting the best price and only care about getting out, the market makers, the firms that provide liquidity by continuously quoting buy and sell prices, effectively quit. They widen their spreads to protect themselves from the chaos. You will see bid-ask spreads that make no sense. A bid to buy at $27 and an offer to sell at $32, a $5 gap. This is the liquidity death spiral. It means the mechanism that connects paper buyers and paper sellers is breaking down. Meanwhile, in the physical market, a completely different reality will take hold. The owners of physical bars and coins will see this paper market chaos, and they will simply refuse to sell. Why would they trade a tangible asset for a collapsing paper promise? This will lead to a situation where the official COMEX spot price might be quoted at $30. But if you walk into a dealer to buy a coin, the lowest price you'll find is $45 or $50 or higher. The premium for physical possession will explode, signaling to the world that the paper price is a complete illusion. This divergence is why Morgan Stanley is telling clients to get out of everything paper. They know that the spot price is about to become a meaningless number, relevant only to those still trapped in the dying derivatives market. The only price that will matter is the one you pay to have real metal in your hand, and that price is set to disconnect from the fiction of the paper exchange entirely. So, what do you do with this information? You need to stop thinking like a gambler and start thinking like a risk manager. Step 1, identify your exposure. Look at your portfolio. Do you own silver? More importantly, how do you own it? If you have silver in an ETF or an unallocated account, you're holding paper. In a structural change event, paper contracts are the first things to fail. You could wake up to find your silver ETF has been liquidated at a price the exchange dictates, which could be zero if they declare a force majeure. Step 2, the conversion window. You have a window of roughly 3 weeks, maybe less, until the end of the month. Your goal should be to move as much of your paper exposure into physical possession as possible. Yes, you will pay a premium over the spot price. Right now, it might cost you $10 over spot. Don't think with a retail mindset. An institutional mindset says, I would rather pay $40 for something real than $30 for a piece of paper that might be worth zero. The premium is your insurance policy against a total systemic failure. Step 3, monitor the red line data. You need to become your own analyst. Check the COMEX Vault inventory report every single day. If you see the registered category drop below 25 million ounces, you are in the danger zone. At that point, an exchange default becomes almost inevitable. Step 4, prepare for bipolar volatility. The paper price is going to behave like a dying star. When the big players cover their shorts, the price will spike. Don't celebrate. When they liquidate their longs, the price will crash. Don't panic and sell. If you are holding physical silver, ignore the spot price. The only price that matters is the price it would cost you to replace that silver if you sold it. That price is set by the physical market, and it is about to disconnect permanently from the paper fiction. Morgan Stanley is out, the smart money knows first, and they are running. The paper bridge is collapsing by month's end. Physical silver is the only lifeboat. This leaked information is your head start. The countdown has started. What you hold in your hands is what matters.